An important choice that all business owners make is how to classify their business. There are a number of entities to choose from with nuanced tax burdens, legal requirements, and structures. Here's what you need to know about forming an S Corp. S corporations are a flexible option for an individual or shareholders to create a corporation. Its structure allows shareholders to avoid corporate taxes with pass-through status, as well as offering limited liability protection. Consider the following benefits and drawbacks of an S Corp. An S Corp is a closely held corporation that elects to be taxed under Subchapter S of Chapter 1 of the IRS Code, granting certain privileges that can reduce its tax obligations and other structural benefits. To meet the requirements of an S Corp, your business must be a domestic corporation, have only allowable shareholders such as certain trusts, estates, and individuals, have no more than 100 shareholders, and have only one class of stock. Certain business types, such as financial institutions and insurance companies, are ineligible to elect to be an S corporation. To register an S Corp, you must submit Form 2553, election by a small business corporation, signed by all the shareholders. There are several benefits to consider if you're interested in forming an S Corp. First of all, your business will have pass-through status. Profits and losses in an S Corp pass through to stakeholders, which means the business won't pay federal taxes at the corporate level and instead is passed through to the shareholders who reported on their personal tax returns, avoiding double taxation. Second, shareholders of S Corps have limited liability. Shareholders are not personally liable for the actions of the company, and their personal assets remain separate and can't be taken to satisfy any corporate debts or legal claims. Another benefit is that the owners, while required to pay themselves a salary, can then distribute profits beyond that as dividends that are free from payroll taxes. Finally, establishing as an S corporation can give your business more credibility over a sole proprietorship or partnership designation. There are a few downsides to consider if you're interested in an S Corp. First, S corporations require formation, including filing articles of incorporation, obtaining a registered agent, and paying the appropriate fees. Depending on the state or locale, this could involve recurring fees such as an annual franchise tax. It's also a more complex tax designation, which means greater IRS scrutiny and more possibilities for a costly mistake. They can also be more cumbersome to manage as they involve mandatory corporate governance like a board of directors, corporate officers, annual shareholder meetings, and minute keeping. Running afoul of S Corp requirements can mean losing the tax designation. Finally, the IRS requires officers and owners of S Corps to make a salary, even if the company has yet to make a profit. S Corp owners and any shareholders who provide substantial services to the company must pay themselves a reasonable salary. A reasonable salary can vary, but it is the equivalent of what employees in your industry earn for similar work. To determine a reasonable salary for yourself and your shareholders, think about time and effort devoted to the business, duties and responsibilities, training and experience, payments to non-shareholder employees, and what comparable businesses pay for similar services. The IRS will look closely at how these shareholders are compensated. If you underpay yourself and rely too heavily on dividends for income, the IRS can reclassify these distributions as a salary and require you to pay employment taxes as well as penalties. To form an S Corp, you must first incorporate your company within your state of operation. This process can vary, but generally involves registering a business name, filing articles of incorporation, paying the necessary fees, and applying for all certificates and licenses relevant to your corporation. Once formed, you need to ensure your existing corporation meets all the requirements related to shareholders and stock. Finally, the corporation must complete and submit Form 2553, election by a small business corporation, within 75 days of the tax year in which the election is to take effect. After receiving the designation, the S Corp must maintain all the corporate requirements or risk losing S Corp status. An S Corp offers advantages to owners and shareholders who can lower tax burdens and facilitate a productive business structure, but the process can lead to a lot of paperwork and confusing details, especially with various state and local laws that may treat S Corps differently than the IRS does. It's helpful when forming any business entity to work with an accounting professional. 1-800-ACCOUNTANT offers expert guidance with experience specific to your entity, industry, and state. Work with the professionals today to get your business started. As always, thanks for watching, and if you found this to be educational or informative, helpful, or entertaining, please like and subscribe, and look for 1-800-ACCOUNTANT on your social media channels of choice.